Hello, my name is Troy White. I'm a financial planner, a financial educator, and today I want to talk to you about a topic. Actually, I got just a little question up on the board, and this is just my way of giving you some advice, and I'm going to go over 5 reasons why. And I do feel a sense of urgency right now. I'll try to convey that. And so what am I talking about? Why you need to do 2 things right now. There's really like one thing, but it's, you might see it as 2 different separate things. And that is, you need to do financial planning and you need to start investing. And for many people, you have done some portion of either or both of those. And but I'm highlighting specifically for those who haven't done any of either. But even for those who have done some, it's time to really dig in and chart out a course for your financial plan from now forward. Secondarily, it's time for you to amp up your investments, really assess what you are currently doing and identify, is it good enough to get you where you're trying to go financially, and if there are things that you could be doing in addition to or instead of some of the things you are doing. And so why you need to seriously start investing and doing your financial planning right now. That's what we're talking about. So the first reason is the simplest thing, and it don't matter when I'm saying that or when this question is asked. The answer really, so I'm acknowledging this to you, and then I'm gonna touch on it, and it is true, and the time to start anything that you want to do is always right now. Put that in capital. Right now. Anything you want to do, right? So let's talk about that. So part of the reasons we don't do some of the things we know we need to do, and we don't take action on some of the things that we want to do and have planned or theorized that we will do, is, we just procrastinate, and we sometimes get paralysis from analysis. We keep thinking, oh, well, should I do this? Should I do that? Should I do that? Should I do this? And sometimes we don't have anyone showing us the path. And I can admit to that on some levels. There are some things that I am eager to do, some business ventures, but I don't have someone to explain to me how do I do this? What is this now? What is the insides, the meat and potatoes of it? At some point you need the nitty gritty, and you need to understand what that is for you to dive in. So I recognize that. So that's one of the reasons why we don't just start now, but the time is now. And because there's a time value of money, so based on the time. So time value of money. If you've seen some of my other videos, you've seen me try to explain this, and basically, compensation for you holding my money costs money. So that's what a loan is. A loan is compensation for you using theirs, and for them to part ways with their dollars for a temporary time, you're going to pay a value for that time that you're holding their money. So it's a time value of money, and that's just embedded in really human society once you develop a currency. So the time is always now. Time value of money combined with compound returns. So time and interest compound on top of each other. So that's the snowball effect that happens. Snowball effect meaning you drop a little snowball down the hill and watch it roll all the way down a mountain. By the time it gets to the bottom of the mountain, it's picked up, so much speed and so much size. It's a big old giant ball. And so that's the same thing that happens with your investments. As they get bigger, because they don't just get a little bit bigger. They always get proportionately bigger. So, that's math. We can go over this one day. I'll bore everyone to death with the math on how investments work. All right, so the time is always right now to start because time is running out. I didn't put that time. There's a time value to money. Compound returns happen in combination with the time value of money, and you are running out of time while we sitting here and you learning this. Time is ticking, so tomorrow is action. So you sitting there this evening listening to this video, watching this video, maybe even taking notes, will understand that tomorrow is one more day that you're running out of time to reach your goal, your ultimate goals. And so you have these things working against you. However, you also have these things working in your favor in investments. So every, investment, you can be on either side of an investment. So although I'm saying running out of time, and so I'm going to put that down too. You need to use time as a tool. I was going to say to your advantage, but never mind to your advantage. Obviously, we do everything we want to do to our advantage. So we're using time as a tool. It's part of the plan. We factoring it in. Not only are we factoring it in, we're using it to our advantage. So these are the subtopics under this one reason why I'm saying the time to start is always right now. All right, why you need to seriously start saving, investing, and financial planning. And specifically your financial plan is really highlighted under this category because we're planning out the time horizon of your investment life. All right, second topic, the reason why you need to start financial planning and investing right now is another obvious one. Obvious to me, you might not even know what I'm talking about. And that is one simple word, and that is inflation. So, inflation is making your money worth less money. And inflation goes hand in hand with some of these issues right here because over time, inflation is actually chewing in to the return, to your compound returns. Because as your returns are compounding, so is inflation. Inflation right now is or historically factor in at 3%, maybe 4%. But on some things, inflation is higher. So inflation is this number represents the speed and the frequency of which prices go up. So as you save in your dollars, well, we need to see what's the frequency, the time value of money, how long did it take for me to turn this $1 into $1.50? And then at the same time, I want to see, well, this loaf of bread started off costing me $1. Well, by the time I made $1.50, maybe the loaf of bread is it costs $1.50. It might even cost $1.53. So what was the point of me holding my dollar all of that time, just making that little amount of money? I thought I was making a lot of money. I'm turning it into $1.50. But lo and behold, everything that I used to be able to buy for $1, I can't even buy it for $1.50. It's cost more than that. So all of that investing that you was doing, that hustle that you did to turn $1 to $1.50, really didn't even keep you above water. It almost kept you in stride. Good thing you made $1.50. It almost kept you in stride, but it's better than if you did nothing, because the dollar is going to be worth less. That's the point. So that's what inflation is, and inflation is hitting everywhere. So you got to consider that you need to have if you had, what inflation is, if you had $100, the same value that you used to get out of this, if at 3% at the end of the year, you need $103 to buy the same things you was going to buy. So that is every year of your life. So every year of your life, your money can't just be sitting in things like what? Like bank accounts. Why would you have your money sitting in the bank account? The first answer, you're going to say, well, I need to pay my bills. I need to use my debit card. All right. So everything above your monthly budgeted expenses should no longer be in there, because the only reason you need a bank account, the only reason you should be using, I'm recommending that you should only use a bank account for the money transactions. So pay your rent, it's a bucket to put the money into for your non-discretionary expenses. Beyond that, your money needs to be working for you. You made the money, now you need the money to help you do things. So if it's $1 above your monthly bills, that dollar need to be invested in your accounts, because it's losing money, because your bank account charges you for having this account. And if they say they pay you, such and such percent, it's like 0.03% or some very minuscule amount, that the various fees that you tend to incur throughout the month actually exceed the interest so they charged you more than they was giving you, is what I'm trying to say. So that's your bank account, and then you're gonna say, well, okay, so then I'll move it over to my savings account, right? And what I'm telling you on that is, that's not achieving anything for you. And that also can make you less than what you're being charged. So, and it's not, etched in stone that this is how it happens. But then when you combine the characteristics of the account with the characteristics of the individual's actual life and the way they handle transactions from those accounts, you tend to incur additional expenses, whether they are insufficient funds or you signed up for some sort of monitoring of the account or some other doodads that they offer you, or that are charged, that don't just come with the basic account. Those fees exceed the interest that you're going to receive. So these are the two least amount, these account types receive the least amount of return. There's going to be the least growth there. Those are not for the purpose of investing in any sort of way, not even sort of a little bit, right? So understand that these are for monies you need within the 1 day to, I'm going to say, 270 days. the next 270 days. And really, we could even break that down and say worse, it shouldn't even be less than that. Like, I could argue for you, any money in here that'll be sitting there beyond 90 days shouldn't be there. Any money that you have in your bank account and savings account in excess of the ins and outs shouldn't even have been there. We should investigate doing something better with that and try to get a better return, because the different accounts are going to get you a better return. Okay. Again, that's part of financial planning. That's what we would go over to figure this out. And then the stock market is currently at a height of all heights. All right. Stock market is at all-time high. And then we're finna talk about that all-time high. So this is when, now this is a combo right here, what I'm about to say. So you need to start investing. So let me say it like this. Oh, you need to start investing. The stock market is at an all-time high, and so you should invest too. All right, but if it's at an all-time high, you heard of this word, volatility. That means the stock market, there's one guarantee I can give you. Stock market goes up and it go down. And then it go back up, then it go back down. And then it go up and then go down. But it tends to do that on an upward trajectory. So it's going in line like this on the way up. It's going up and down on its way up. That's what's happening, right? So that's what volatility is. And so we currently at a height of all heights. So it's being anticipated that the economy, various factors are going to come together at some point to slow down the stock market. And so you're likely to get a crash. So what I need to kind of talk this through to you, because there's two perspectives, right? And both of them are idiots, right? Okay, one idiot says, hey, the market is at an all-time high. We need to get in the market. So what that means is market is at an all-time high. So you're going to do like most Americans and buy it at the all-time high. So you buy it at the height, and then what I just say, it's likely a crash is coming at some point. And so let's buy it at the all-time high, right? And then you get the crash go down back to here, right? And so then you say, oh no, I lost all the family wealth. And so now you're mad, you're crying, you're sad. And what do? So you buy it and then you sell it. Hey, the market is at an all-time high. Let's buy some stock. Crash. Oh no, let's sell it before we lose it all. You damn near lost it all. So you sell it, and now you officially are a loser. You bought high and you sold low. Understand, that's what most fools do. All right? So that's that one argument. And so the other negative argument, so that's an argument, I'm arguing against that one, being all enthusiastic and jumping in at the all-time high. So the other argument is, the market, the stock market is at an all-time high, so it's likely to be that crash. I could have left that little chart up there. It's likely to be that crash. So once you wait till that crash and then start going. But the problem is, where do you know you at? Here's the crash. Here's where the last people bought, buy, and sold. So How do you know we're not just right here right now? Or even right here? This might be imminent. I mean, this might be imminent, but we're all right here right now. So, what do that mean for you as an investor? That's why I said you can't get away from this. You must do your financial planning, especially that you know this is about to happen. So are you going to be the fool that buys high and sells low? Or do you understand that it's a way to make profit, to have a gain, to have the proper strategy to where you buy the average price? And this is the bottom. What's going to happen? It's probably going to do that, and this is going to happen in a very short span. But this might just be like 6 days from here. You know, this could have even took months, but this might take days right here for you to be right back, and then this could take a couple more months from now. But this is how it happens. And so this line right here is going to be called is dollar cost averaging. So what we're going to be doing with your portfolio is investing on a regular basis a certain amount consistently. We don't care what it's selling for. We don't care nothing about that. And so, would you prefer to be this guy who bought it way up here and sold it down there, or you be this person who is getting an average? These are the same days you bought it. Your average price is way more even than this person because you consistently buying it on one day of the month. Every month, I'm buying that. I'm buying that. So wild swings don't bother you because you're going to buy it next month too, at the high, at the low. So you're going to get those benefits, and your average price tends to be, statistically shows, the numbers show that if you dollar cost average, you win in terms of you're not in this buy high, and you don't get scared when a person who does dollar cost averaging, when a market crash occurs, if you're anything like me, you kind of smile and you get happy, and you want it to crash some more because you know that you are about to buy on a certain day a specific chunk. You're investing X amount of dollars. I don't care what it's selling at. I'm investing $1,000 a month or $100 a month, and that's what I'm buying it. I'm gonna buy it, whatever the price is. So that's the aspect about the stock market being at an all-time high. It's not gonna stay at an all-time high, and it's gonna be an all-time crash. So how you need to understand this so that you can take advantage of the stock market, but you don't do it in such a wrong way and in a blind way, so as to you feel like you are negatively affected, and you're going to have a sour feeling about the stock market forever, because a lot of people do a lot of bragging on how good they are at picking a stock or two when the market is at an all-time high. And think about that. So if the market is at an all-time high, that means almost everything is up. So everybody can brag. Then everybody can say, oh yeah, my stock is doing this, that, and the other. Yeah, the market is up. So let me hear what they got to say when the market is down. Now how you going to make some money? Now how do you invest when the market is down? Now what's your strategy? That's why we need to do this. It's not enough to just be, oh, let me pick a stock and put a couple $100 in this account and do that and that. If that's just the way you like to have fun, instead of knitting, needlepoint, you like to just pick a stock and do that. That's about the effectiveness of that. You might have to make enough to buy a car, or maybe go to the movies, of all year or something like that. But that's not how you invest. You need to invest with a plan. You need to do financial planning. All right. The other point that I wanted to discuss was because that I mentioned it actually, and that is the recession. How do you spell recession? All right, I understand I'm gonna spell it wrong, right? Recession. Might have two C's up in there, something like that. All right, the recession is coming. I keep hearing it. I keep reading it. I understand it because the economy goes in a cycle. This is not just the economy of the U.S. Economies that consist of human involvement, and it's the cycle of an economic of an economy. I was going to say it, the other economic cycle. Basically, you have drought, economic drought, and then you have economic development, economic expansion, over expansion, and then it's a word. It's not drought. It's like then you have a recession. That's what it is. That is it. So you have, and it goes that way with real estate as well. Real estate development. It's a similar cycle, and they are connected. And as well, that cycle is connected to the stock market as well. There are various reactions to those actions, for each. It's a give and take. So again, back to this, you can't just think you can buy a stock all the time. You got to know which stock, what, and not just that. I didn't even want to talk about that. You need to know which one to put into which account. You need the different ones account because they got all different tax effects, tax implications is what I was looking for. So speaking specifically on the recession, this is where I'm saying this is where it gets the rubber hits the road for the right now. That's why you need to start right now, is because there are some things that you need to start doing right now to make yourself inflation proof. And just listing a few. First off is to create a rainy day fund right now, while you still have the means and the recession hasn't hit. You need a minimum of $1,000 in an emergency fund, but preferably you're going to get. If we were working together, my strategy is that you build a $1,000 emergency fund, but we're never going to have monies idle. But we want to have a strategy to have liquid assets that equal 3 months of your mandatory expenses, and after we achieve that goal, we want 6 months of those expenses on hand, liquid assets. But at all times, we are also investing to try to achieve the highest return possible. So again, back to financial planning. So we have that it's a seesaw. It's a yin yang, give and take on, well, how much do I try to hold in reserve versus invest, because those goals are competing. They don't fit. They don't jive together. You can't do the same. So that's a whole nother conversation. But embedded in that is when I say the recession is coming, is because we do need to build up that rainy day fund. And so also what we need to do is try to use this time before the recession. And again, I mentioned when the recession hits, the stock market is affected, but so is real estate. So we need to do two things in that regard. We need to have an income generating property, preferably before the recession hits. And so I'm saying through financial planning, you need to put yourself in the financial position so that you can acquire this first income generating property. So what I'm saying, basically the goal that I would have for you is, hey, try to get a 4-unit property before this recession hit. When the recession hits, we also, remember, said we're building up your rainy day fund. That's not just for negative emergencies, it's for positive emergencies. So it might be an investment opportunity that comes your way. So we want to have assets available, or some methodology available, ready and prepared for when a recession hits. The reaction to the real estate market is going to be that there are going to be some deals out there, and you need to be ready to grab some. And the reason I said you should have one before the recession hit is because in a recession people lose their homes, but people who lose their homes then go rent instead of buy. So I want you to be renting to them. And when the people lose their home, that means there's a lot of homes that are available on a short sale on foreclosures. So you're going to be getting bottom basement prices on these properties. So what I'm saying, we need to get yourself ready for this inevitable occurrence to take place. This is what happens in the economy. I'm not saying that, hey, this unique thing is about to occur. No, this is what happens. This is how it happens. And so it's about which side are you going to be on. Because if you don't plan for this financial environment that is forthcoming, then you're going to be on the wrong side of it. So at least listen to some of the points to consider, like, oh, okay, let me make sure I'm not in this situation at this time, something like that. So basically, I'm saying during this recession, we need to also consider the reaction of a recession on the real estate environment, market, or whatever, environment. You know what I mean? So, and those are work together. I shouldn't say they work together. There's an action and reaction that each have, and it can tend to be a spiral effect that helps worsen a recession. But understand that the recession is a regular occurrence in an economic cycle. So if you get on the right side of it and you ride it the right way, then you can capture all the gold from all the people who about to lose it. And the gold, and what I'm saying is the gold here and the gold here. So essentially, the story is, don't be scared, get prepared, because when the recession hit, it discombobulates everybody and it had you second guessing what you're doing. But understand that when going in, it's going to be a way out. So try to gather up all that you can. It's the drought season. I was going to sing the song, but you know what I'm saying. So during the recession, real estate prices are going to go down. Stock market is likely to crash, and there are going to be deals. So, and what else happens? Why I'm telling you this? Jobs. People lose jobs. During a recession, the stock market crashes. When the stock market crashes, there are going to be some companies that go out of business. Period. When those companies go out of business, people lose jobs. As people lose jobs, there are less consumers, meaning less people to buy stuff. If there's less people to buy stuff, it's more or less jobs. Then as it's less jobs, it's less people to buy stuff. That's what a recession is. So these two keep feeding back on each other. So you lose your job, you don't come to my store and buy something from me. So then I gotta fire somebody. So that person can't come to your store, the next store, and buy stuff from them. And that means they had to fire somebody. And that person can't go to the store they used to go to buy. And so that's what a recession is. Blam, blam, blam. So when that happened, these people who lost their jobs can't pay their mortgage. And so they get foreclosed. And so they no longer are investing in their 401k because they lost their job. And so that causes less buyers than sellers, right? So less buyers than people who want to sell means the price go down. So these companies lose their valuation. That's a recession. These three things happening. And when that happens, these people can't pay the mortgage, can't pay. So then it's real estate happening. So remember what I said, we bought rental property. So you receiving, but rents go up. Because these people are now competing for the same rental space. People who can't pay their mortgage and got foreclosed on, all competing for. So now you was getting $1,000 a month. Now you're getting $13 a month on your rental, and you went and bought the house that they had to get out of because they were paying $2,500 though. So they had to downsize, but you went and bought that, but you bought it for pennies on the dollar. So you don't have to pay what they was paying for. That's how that cycle comes. So now you start to see, oh, okay, now you're a real estate investor. And you gobbling up everything because of the coming recession. So anyway, I'm going to stop there. I'm going to cut it. But these are the real estate investment cycle, the coming recession, stock market being at an all-time high, the fact that inflation is chewing away at your dollars and your savings, combined with the fact that now is always the time to get started doing what you need to do. And what you need to do is invest, and you need to get a personal financial plan for you, yourself, and your family. So that's why you need to start financial planning and investing right now. You can go to my website, learn more, www.hoodoofinancial.com. Shoot me an email, twhite@hoodoofinancial.com. Thanks for listening. Holla.